Hey, good morning, good afternoon, everyone. How are you doing? Good afternoon to you as well, Rameshi. Hey, Sam. Okay. What do you guys have for me today? Namaste, namaste. I love these different type of greetings. uh,
Hello.
okay, I see a new name. Uh, Let me see. It looks like there are some new folks out here while we wait for others to join. Anya, is this your first time? Hopefully, I'm saying your name correctly.
Yes, this is my first time. Hi,
What
guys.
brings you here? So I just wondered what brings you here? How did you find us? And what kind of an investor are you?
So I found you guys on a meetup application, and I doing some Robinhood trading for several years already, and I want to learn some options trading as well. Yeah,
Okay. So I heard
I
you
have
on.
some experience. Yeah, I do
Okay.
have it.
So when it comes to options, I just finished a boot camp of options. You know, this week was our last session on options. So I don't know when I'll do next one, but the recordings are up there. We want to see, I mean, if you are new to options, maybe that will be useful because I cover right from very basics of options all the way to, how to manage portfolio using options. But if you have any questions specifically on around options, feel free to ask in here. Generally, we don't, I don't get into looking at individual option trades. I use options as an overlay on my overall portfolio. So that's how I use options. But if you have any questions, yeah, feel free bring it here in this meeting.
Absolutely. Thank you very much.
Sure. What else? I think. Yeah, I don't even know iPhone is a new person or not. There's many iPhones. I see another person, Ozone. Sorry if I butchered your name. I don't recognize that this name maybe first time.
Yes, first time. Yeah, you said it correctly.
Okay, thank you. So yeah, what brings you here and what you are looking to accomplish from spending these 2 hours?
Just to learn a little bit more about stocks. I've been doing it for a while, but um, just trying to gather more information, getting also more into options. So I heard what you just mentioned. So I know this might not be the best uh, time for that, but that's okay.
Sure. So it looks like there. So I just uploaded the last session also on the website. So you can get access to the bootcamp that I just finished, like July. This Wednesday was our last session. My website is optiongig.com. You can just register for free and come here and say bootcamp. So you'll have access to all the recordings. And again, I did this, just to help anyone who's entirely new to options. So we start with very basics, introduction, newbie strategies, talk about little more deeper concepts. If you have a small account, what strategies can use? Drill number 4, moving forward, when you open an option trade, what are the checklist, pricing, assignment risk? Then we talk about little more uh, so-called complex strategy, but there's nothing in option that's complex. It's anyway combination of calls and puts. Then trade closing, then how to manage your trades that are going against you. Now we're getting into the advanced section, deltas and Greeks, and finally how to manage option portfolio. So yeah, if you have never dealt in options, maybe this is one place you can look at. There is a lot of wealth and knowledge around options freely available on internet. So I really urge you, if anyone is charging you for like kind of teaching options, you should run the other way around. Okay? There is absolutely no need to pay to learn what the option concepts. And I can't tell you how many people I've encountered who have paid a few thousands of dollars to get into some option courses, etc. Right? So don't do that. There are a lot of free information available. If you want more info on it, yeah, just ping me, and we can talk about it. There's again, I've also learned from freely available information around the web. So there is no reason why you can't do it yourself. Okay. All right. Any other person joining for the first time today? Let me go through the list. Nope. All other names look familiar. All right. So what do I have on my list? First of all, I need to remind myself we have to go for a housewarming party, and I don't want to be late. So we'll stop here at 2 o'clock. I know sometimes we get so, we have so much fun here that like last week, what we spent 2 hours, 45 minutes. I thought that was the record, but some of you had corrected me that in some sessions we've gone all the way to 3 hours. Hopefully we'll not do that today.
Vivek,
Yes,
thank
Sam.
you. You said our meeting is going to 2 a.m. Thank you. 4 hours?
Oh, no, sometimes we've gone, I think, maximum 3 hours. So
Oh, Vivek, you said 2 o'clock. I think you meant 12 o'clock.
yeah, today I need to finish at 12 o'clock. Yeah, sorry. Yeah, not two. By the time if I finish at 2, the lunch will be over at the housewarming place, man. I need to then cook for myself. Okay. All right. So yeah, what do I want to talk about today? I know last week some of you had asked me to, hey, can we talk about these stocks? So what I decided is maybe we can have that as our first topic to start with. Like first 30 minutes, we can cover some of the stocks that you wanted me to review. And if there are any other stocks that you want me to look at for the next session, do let me know. So I'll go through those. And of course, we had earnings. It's earnings season. So we'll start to get earnings from many companies. I want to look at a Google and rather say Alphabet and Tesla. Those are two earnings. Go through an article from Howard Marks. Yeah, and then there's a brief note on study on founders-led companies. Yeah, I guess that's it. And of course, like a generally looking at stock and some thoughts around investing. I'm a big fan of building mindset for investing because I was so wrong when I started investing. I thought you all need to be very smart and high IQ and all that stuff. Later on, I realized it's more about mindset. So I always want to focus on that. What else? Any other questions that you may have? We can talk about that. So there is a question. Alfred says, CMG has been dropping. It's under 50. Do we know why? CMG had a roller coaster ride just after earnings. And if you realize, generally during the earnings time, I'm like preparing lunch and then I'll put CNBC on my iPad. That'll be blaring whatever the host has to say. And I realized that CMG was up, 12, 14% right after earnings. By the time I got to my, dining table and started eating, and I realized that the CMG has dropped down. It was like -1%. I don't know where it ended up. So here's, I think, what had happened. From a results perspective, those are all fine. I think they grew their store count. Again, I don't follow CMG very closely because I don't have stocks, but their revenue grew year over year. Not just the both things contributed to the revenue. Number one, the number of transactions means the number of purchases were high. Plus, also they increased the prices, so both contributed, which is good. They opened new stores, which is fine. So that's why market was very enthusiastic about CMG. Now, why did it drop suddenly? Because the outgoing CFO made a comment that the margins will be, he sees that the margins will be under pressure for in the second half of the year. And that's the reason why market, I don't know, it could be just algos, who knows? But that's the reason why it had a roller coaster ride from, from up, whatever, 12, 14% to down wherever it is right now. Aditya says, did you get a chance to review Scottish mortgage? No, because I mean, I looked at it. We looked at during the meeting itself. I am not a big fan of companies that change their business model based on what's hot right now. Right? So Scottish mortgage is now coming up with vehicles for allowing investors to invest in those AI companies, private companies, and all that stuff. I'm not a big fan of that. So I would not be investing in Scottish mortgage. But I did not have the ticker handy. Maybe I forgot to take a note of that. So I did not really look into its, last year's, to go through the criteria. But I do recall that we talked about Scottish mortgage, and I still have the same thoughts about it, that I don't want to invest in. Same is the case with Fundrise. Right? And I am seeing more and more companies trying to come up with these instruments and trying to attract investing dollars. I'm not a big fan of that. I don't know, Aditya, did you want to talk about something else on Scottish mortgage? But that's my thought on Scottish mortgage.
Yes, no, thank you for sharing that. I agree. Just historically, I think the names of this one slightly misleading, but it's basically, I initially got into this company as a way of getting into private equity.
Okay.
They hold some companies like Wise and Spotify, which earlier they were not publicly listed companies. And I agree with you, they've got a lot in their portfolio. For a long time, they did very well, but it was an actively managed fund. So the primary manager left, and since then, it got really overvalued during COVID, and since then, last 5 years has been a bit underwhelming, actually. So I just thought I'll it would have been interesting to know your thoughts, but now I know them, and yeah, so that's the backstory. Thank you.
Okay, no problem. Yeah, so if you really want to invest in, there are many vehicles, like these are the ones which private credit and helping or allowing users to invest in still private companies. There are many players in this market. There are other ones which are, let's say, I think there's secondary share post. There are 2 or 3 websites. I forgot, Forge. They also allow you to invest in the company, in the shares of a companies that are not yet publicly listed. So for example, if you want to take some stake in SpaceX, and if some of the employees of SpaceX want to share, they can sell the shares in the secondary market. My only concern, not a concern, but as myself as an investor, I am not a big fan of investing in these private companies until I have a portfolio that I can spread out and fan out my investments around 50 tickers, right? This is like a venture investing. I know venture funding, angel investing sounds very sexy, but you need to understand that the basic methodology around venture investing is, spray and pray. And even however successful venture investor you may be, at the end of the day, they really don't have any idea of which one will become Facebook and which one will become WeWork. So do you do all your due diligence and invest in, and you really still don't know, right? So the idea is that's why the venture investors will invest in multiple companies trying to hedge their bets. Unless your portfolio or my portfolio is as big that angel investing, I can do enough, at least 50 companies. I don't want to touch it. That's just me. But I see a lot of folks getting very excited about angel investing. More power to you. You may be able to, to withstand the, many losses before you hit one Facebook or one Google. But yeah, that's the attractiveness of investing in these private companies. Okay. Alfred
Thank you.
said, hey, no problem. Google
So
was
just
down to 163.
one,
Sorry, go ahead.
so you mentioned Forge Investment. Is that a platform?
Yes, they bought other platform, which now I can't recall the name, but that was, in fact, I had an account on that one, but I never bought anything, so they keep sending me email. It starts with E. Someone else might recall the name. And I know in 2021, I reviewed many of these platforms which allow you to invest in these secondary shares. Does someone recall what's the company's name starting with E? Which, and I think Forge Global had acquired that company. So it's Forge Global. If you can just Google for it, you
Yes,
should.
yes. Thank you. I'll check them out. Thank you.
Google was down to 163. It was up about 192 in July. Yeah, so we will talk about Alphabet. Google was down because market didn't like their CapEx spending. If Google doesn't spend, market doesn't like it. Google spends, market still doesn't like it. So I don't know what market Mr. Market has. So we will talk about Google. It's when we cover the investing. Okay. All right. So let's get started with our regular discussion. So I have some content that I'll go through it. You guys know the drill. And any questions, etc., please bring up. Okay, don't be shy. It's more fun when it is more interactive. All right. So as always, anything that we discuss here is not an investment or financial or tax advice. You guys talk to the professionals. I'm no professional. I don't come from financial services background. I come from most of my life has been spent in technology sector. So maybe we can talk about some little bit technology, but yeah, don't follow me for financial advice. Okay. All right. First thing, don't bet against US economy. We had a GDP numbers out, and that's like grew at 2.8% in Q2. It was way above the expectations of like 1.9%. That's why I said this is like a NVIDIA's results. NVIDIA will blow up the expectations out of the water, and that's what the GDP also did. I mean, 1.9 versus 2.8, that's a big change when you're talking about GDP, right? That's like a trillions of dollars of change. And what happened to all those PhDs and economists and all the forecasters that Fed has? Fed has 400, 500 PhDs in different fields, and they can also be off, right? So that's why we'll talk about why uncertainty is good for us as an investor, because no one knows. Right? Everyone can try to predict. No one knows what's going to happen, and we all have to figure out how to live with it and be comfortable with it when we are investing. So consumer spending was up 2.3%, and that was the main reason why the overall we had like 2.8% growth. Now you could look at it both ways. First could be, GDP is still going strong, economy is still going strong, so why would Fed cuts the rates? I mean, we are priced in 99%. Let me just pick up the Fed watch and see what's the latest number in terms of the price cut. So let's see how much of the price cut have you already priced in. Come on, probabilities. So we're looking at 88%, almost 90% have been priced in, saying that we will have a at least 25% basis points cut in September. So market is pricing in that we're going to get a price cut. Now, whether we will get or not, that no one knows. That only Jerome Powell knows, and he's not going to reveal his cards right now. So we'll have to see. What if we get on July 31st? I think July 31st is FOMC meeting. So it is this week. So FOMC will meet on Tuesdays and Wednesday, and around Wednesday afternoon, or maybe 11 o'clock, they'll reveal whatever their thoughts are on interest rates. So if we get it on July, no one is expecting. Right now, market is not pricing in any cut in July. But 90% of market is, 90% probability of cut in September. But if you don't get a cut in September, that's a different matter. That we should see some more weakness in market. So economy stays strong, which is good. Markets this week wasn't that great, but I came across another chart of 2023 performance of the world markets. So looking at US, obviously S&P was up 17.2%. Japan was up percentage change on December. Is this correct, or did I mislabel it? No, so I think this is from December 29th till date, till July 17th, right? This is heading is not correct. So from December, that means almost YTD till July 17th, right? So S&P is up 17%. NASDAQ was up 20%. And of course, China is not working out. China is down. Shanghai Composite is down 0.4%. Japan is up 23%, right? And this confirms the thesis that we talked about, I think, last August, wherein the Japanese regulators, and we don't see that it's in US, have become very conscious of the fact that many of the companies in Japan are trading below their book value. And they've been kind of, I don't think they can really have an official order, but kind of unofficial guidance that you need to clean up your books. So we've been seeing Japanese stocks performing since, I think, the mid of last year. And of course, if you go back, we talked about the whole thesis of investing in Japan, including, now the tourism and all that stuff, how it is going to be good for Japanese economy. So Japan performed almost 23%. And these are like not adjusted for currency fluctuations. These are the nominal growth rate. Turkey is up 50%, right? But we'll also have to check in terms of what's the lira, how much that has lost against dollar. But I was surprised to see Turkey up 50%. But I do see the reference of Turkey in many of the value investing folks. I don't know. Maybe the companies in Turkey are way undervalued. And maybe we'll have to find out, how do you invest in companies in Turkey? Anyone out here uses Interactive Broker? Because that's one broker I heard of that allows you to directly invest in not just the ADRs. I mean, ADRs I can invest using any regular brokerage firm, but you could invest directly in foreign exchanges, foreign stock exchanges. Anyone has any experience with investing in Turkey?
I think like Monish Pabrai, he invests in Turkey. That's like the only investor I know.
Yeah, Monish talks about his investment in Turkey and how does it go. He has some friends and he visits a lot of companies in Turkey. But I also heard Joel Greenblatt, but Turkey has come up as a investing destination in more than Monish Pabrai.
Okay.
Yeah. What else? Taiwan up 32%. I was a little surprised on that, but maybe if you really look at TSM, which is, I think, the biggest company in Taiwan. How much is TSM up this year? So let's look at TSMC. In dollar terms, it's up almost 60% year to date. And I think TSM is the biggest public company on Taiwan exchange. So yeah, then I shouldn't be surprised that Taiwan is up 32%. Argentina is up 64%, but I'm not going to run after Argentina because that's an inflation issues. These are nominal gains and not dollar adjusted. So yeah, but something again, I know a lot of us, I'm a lot of interested in emerging markets, but US markets not bad, right? 17% in 6 months. Right? What else can we ask for? Turkey, high inflation. Inflation was 75%. Okay, that also contributes to 50% gain. All right. So what did we do in US? Friday was a good day. We switched from red to green. I know I just put a chart in Slack saying, hey, this is a red box because I don't know, was that Wednesday or Thursday? These big boxes were all red. So I said, hey, there's a red box sale going on in case you have your watch list ready. And that's why we should have our watch list so we can take advantage when some of those sales are going on. And those goods were off sale on Friday. Most of the things were up. But if you're a new investor, the weekly performance might just still disappoint you. But for the week, doesn't really matter. I mean, a week doesn't matter much. But if you're just getting into the markets, yeah. And it's very common. We want to look at, hey, how did my investment do? I just got into it. And Microsoft is down like almost 2.75%. NVIDIA is down 4%. All the chip stocks, right, got the chips off their shoulders, right? So you got Broadcom is down 3.6%. So Broadcom recently split its shares. Looks like that isn't helping them. Over, I think, last 6 months, there was, it was kind of almost certain that if you split your stock, market will push up the stock price. Didn't really work for Broadcom, looks like. AMD is down, almost 8%. That's interesting. NVIDIA, AMD, yeah, Qualcomm is down 3%. Overall, I think the tech sector, let me put it this way. The sectors that have worked so far were down. Some of the sectors that have not worked so far are still doing better. So maybe rotation going on. Who knows? Maybe it's some profit taking going on. You see a little bit weakness on market, and it's a human tendency to take profits, to capture the gains. It's just how our mind is wired to work. We hate losses. The pain of a loss is twice or thrice more than the joy of gain. So we tried our level best to avoid loss. This is called a loss aversion, right? One of the cognitive biases that we have is loss aversion. And as an investor, we really have to fight it. We need to first understand it. I'm selling it. Is it because I'm no longer, my thesis has changed, or is it I'm practicing or I'm being a victim of a loss aversion? This is why we still don't sell many of the stocks that are losing and maybe the business is broken, because then I'll realize the loss. I don't want to do that. I don't want to realize the loss. So anyway, maybe some profit taking is going on over there. Who knows? Sarah said, what do you think about Lulu? Leaves look like a great deal on a good company. The question around Lulu is Lulu's stock, of course, has fallen a lot. The weird question, is it a value play or is it a value trap? Right? Wow, now Lulu is trading at 52-week low. So first we need to understand what is causing this. Right? Does it not have the brand power that we thought it had? I mean, we have seen these things happening with Nike as well, right? Of course, Nike, I know what things that they did, which didn't work out. Lulu, again, I've not followed with Lulu on, what their revenue, etc. So I've not looked at their business, but understand one thing, and I think this applies, and that's why I've not invested in Nike, even though Nike looks to be or Lulu or a company like the Hoka company, the Dockers or On shoes. When it looks at long term, consumer fashion goods related, not, I mean, the tastes are a little fickle. But if you already know Lulu, and if you like the company and you think that this is right now a value stock and trading at a much cheaper valuation, and you want to open a position in it, leaves, because right now that's I mean, I'm right now not a big favor of just buying leap on a stock, because we have a skew on the call side. You end up paying more for the extrinsic value, and given the fact that Fed is going to reduce the interest rates, you will have a much bigger impact on the leaps because of rho. So I never used to talk about the impact of interest rates on options, because we almost had like interest rates were not changing at all. Right? Things have become different in last 2 years because the Fed has increased the interest rates from almost 25 basis points to 525 basis points, right? So that has impacted a lot of option pricing, especially longer the time duration, longer is the impact of interest rate on the option pricing. And the reason, since 2022, ever since Fed has started to increase the interest rates, that's the reason why we see a lot of products in the market that sell call options to generate some income, right? Yield max products, buffered ETFs, you call no risk ETFs. Now I'm seeing annuity is coming up with that. Why? Because you got a skew on the call side. So if you are taking a leap position on any stocks, not just Lulu, but that's a generic comment, understand that with the decrease in the interest rates, you will see a much bigger impact on your call options, which are further down the line, which are like a leaps, right? So understand that. Number one, we are paying higher. And if a Fed, not if, I think it's not a question of if, but it's a question of when, right? And when Fed will reduce the interest rates, you will see the value of call options decreasing more than what you might have had experience with in the past. So there could be other way. You could negate it. I'm not sure you can. Yeah. So the call sides will be impacted more. So that's my only concern. As long as you understand that and want to buy some leaps, sure. Make sure you buy maybe deep in the money leap. Do more as a stock substitution than trying to buy the lottery tickets. I'm not a big fan of buying out of a money call options as a lottery ticket. Pay less for extrinsic value, buy deep in the money. But only do it if you think the Lulu is a value a stock and not a value trap. So I'll take, I mean, do you want me to look at Lulu? Maybe next week we'll run Lulu through some of the criteria, which, and I'll show you, like last week you gave me some stocks, so I look on those. I read somewhere the high-end brands like Gucci, etc. dropping. Yes, and I didn't understand why, because mostly luxury products should do good. But I also heard these luxury brands had a tough time. I don't know how about the LVMH, because last year, I mean, it was doing good. Again, I'm not, don't follow this very closely, so I could be wrong. But I do recall listening or hearing about the company that owns Gucci. And for rest of my life, I can't recall what's the name of that company. You will never have heard about that company, but that's a company which is behind the Gucci brand.
I think it's like Caring or something like that.
Yeah, some I'm like, what is this company? Then they say, oh, they own Gucci. And I'm like, okay, I've never heard about this company.
Yeah.
So but YTD performance, even though, this week might not feel good, but there is nothing to worry about, man. Like S&P 500, 14.5% up. So don't complain. There's nothing to complain. I mean, this is still like bigger return, higher return than average, right? So we are still above average. So what's there to complain, right? And don't get scared out of the market just because in 1 week, whatever, we were down percent or 2%. I know the tech is down 2.5%, but overall we still look good. Now all the sectors are in good. Last week, real estate sector came in green and is still green. So if you are invested in the market, you made 14% without doing much work, but blindly just investing into the big basket of companies. We don't have to get too cute with our investment. And rather than having money sit in the bank, yeah, why not enjoy the 14%? So still, I mean, there is nothing to complain about. Markets are still looking good. A week or two doesn't matter. And the fear and greed index, the gauge, is now turned. I'm waiting for it to move into fear so that we can buy some more, become a little more aggressive in buying some companies. But I'll wait. Still at a neutral. Ramesh says it's a roller coaster. India was up 702. I guess that's maybe a comment around Lulu. Or I don't know, was Lulu up to 700? Cost down to, why should cost not be? I just can't understand how come any investor be paying so much for Costco. Costco is a great company. Costco is a great business. They have a recurring business, more than 95% renewal rate. They're going to increase the membership fee by another, what, $5, $10, $15? I don't know, but there was a news around they're going to increase the membership fee. But the people will still, keep the Costco membership. So it's a great business. Like we talked about multiple times, great companies, great business, great technology may not be the great investments. That's a problem. Costco, it's a business that you should hold it and never sell it, but not right now. I can't invest in Costco right now because it's at the end of it, it's a consumer staples company, and now it's trading at like 50 times price to sales. Price to earnings. Just doesn't make sense. So I've been waiting for Costco to come down to a little more, a better valuation to take any positions in that. It's not a high growth company. So that's why if you invest in Costco at such a high valuation, you will have a lousy investment on a great business. That's the problem. So more power to those who have bought Costco at much cheaper valuation. I can't, put myself to put in money in Costco at such a high valuation. So, and yeah, if it has gone down, I think maybe it still need to go down further. It's 817, right? So, yeah, I have my eyes on Costco, but I can't invest at this valuation. How do they calculate fear and greed index? Just go to, there are 7 parameters that they use. If you go to the CNN page where they show the chart, you'll know what those 7 are. I talked about this in one of our previous meetings, so I'll not repeat it, but they look at put and call ratio, they look at market breadth, they look at how many are, percentage up or down. There are 7 criteria. And I've been looking at this for almost now 4.5 years. And this, to me, it's a good gauge. I mean, it works for me. So I do want to look at, what's the fear and gauge index. Okay, so I took note of these tickers last week that you brought up during the discussion. Match, WULF, I don't forgot. This is Make My Trip. An India-based company, Square, now called as Block, and this is Lattice Semiconductor. So let's go through this. And again, I'll give you I want to review it with you so that I just want to share with you the thought process that you can use and apply for any companies that you are interested in. Okay. So let's do a match. And I think there is one more, AEHR, right? So let me start with that first. So I did, okay, I'll come to AEHR a little later. Let's do the match first. Okay, there's a match group. Okay. So we all know what's a match group, basically dating, the software company. So the reason I pulled off AEHR because I want to first share the thought process of, again, I'm learning. I'm trying to figure out new stuff, a thought process, and then we'll all go together. I forgot who had asked for match. Let's make sure that the person is here. Otherwise, I can skip match.
Oh, I think I talked about Match and Bumble.
Okay, Match and Bumble, right? Yeah. So I think Bumble we already discussed in last week meeting, but let's talk about Match. Okay, so first look at how their TTM numbers are looking, right? You can see this. It's not an eye chart, I hope. Okay, 14 PE ratio, which is not too bad for a software company because you're generally capital light. It is trading less than the overall, cheaper valuation perspective than overall market. Forward P, again, almost the same. PEG ratio 0.51, which means considering growth, it's still cheaper, not too bad. Revenue 3.44 billion, net income is 653, almost half a billion. What else? Shares outstanding 265, market cap 8.83, enterprise value is 11.76. So for number one, difference between market cap and enterprise value tells me how much is the net debt that they have, net debt minus cash that they have on their balance sheet. So this means clearly they have almost $3 billion of a debt that they continue need to service, right? Which is almost their revenue for the year. Okay. This is more volatile than the market. Forget about 52-week high, 52-week low, 200 moving average if you're interested in. So let's look at, I think one data point that I got from here is the debt. They do have a debt on their balance sheet, and which is almost as big as their yearly revenue. So now let's look at and match it against some of the high compounders, the criteria that I have. Gross profit above, above 40%. This is 71%, which is great. ROI on an average is less. Let's do it only for 1 year. Okay, last 1 year ROI, return on investment 20%. Insider ownership is fine. Operating margin average, I'm a little concerned about here. If it's just a software company, should have little higher operating margin. Right? So difference between the gross profit and operating margin is like huge. And I think even the bigger companies like Microsoft, the tech companies like Microsoft has better operating margin. So I'm a little concerned about. Revenue growing at 6% year over year, which is very less. They grew their EPS. Maybe there's some additional extra income. I don't know. Not a capital intensive, so these all parameters look good, and they actually had a real cash flow. So let's look at on the other one, which is Warren Buffett, thumb rule. Nice gross margin. They're spending a lot on SG&A. 40% of their gross profit goes towards marketing expenses, and only 16% to R&D, right? It means that, I don't know, they don't have that much of a branding pull, or there's a lot more competition that they have to spend so much on their marketing and sales. interest margin, fine, tax margin, net income, we already looked at. Cash to debt, this is a concerning. The amount of a cash that they hold on their balance sheet only covers 20% of their debt, right? Which is really, really bad. It means in times of distress, this company could run into problems, right? If you look at all the companies that have survived through, 50, 100 decades, like 500 old companies in Japan, and we actually looked at some of those studies. There was an article that I reviewed. Companies that are 500 years old in Japan, they all had one thing in common, which was very low debt or almost no debt. Debt kills you. I'm concerned about this, and that this shows up, and debt to equity is negative. What? 1.9. So there's something funky going around the debt to equity. How come the debt is so higher and equity negative? So we need to now look into what's happening with the debt and equity. Okay. And retained earnings, no retained earnings. So they're draining earnings. And of course, revenue is not growing much. It's like 6%, 5.5%. So now I want to look deeper into what's happening with what's the funky stuff going on?
Oh, I think I'll give a little bit of, I think it's like the debts because they did like a lot of acquisitions and stuff like that.
And they basically leverage their balance sheet to do the acquisition.
Yeah, obviously, yeah.
Yeah. So sometimes this is what happens. Like the CEO will try to grow their empire without it being. This is where we have a classic agency and principal problem that I think Warren Buffett talks about. I am the principal. If you are a shareholder of a company, you are the principal. CEO is an agent. It's your agent. It's your servant. CEO is at service to you to make sure that you are benefiting by the actions of CEO. But then we get into this classic agent principal problem wherein the CEO is trying to increase their influence, their empire, which may not be positive for the principal, which is you as a shareholder. So let's look into their debt to equity and see what the heck is happening there. So I'll maybe go to their annual. Let's look at all their annual, or maybe look at annual report and see what else I want to try. Total assets, total liabilities, and how much do they have debt? Hold on. So they got 3842 of so total liabilities is 4527. What's the total assets? 4508. Okay, so you're right. So they have more debt than they actually have assets. So in case of, let's say, any issues around the company, they don't really have any assets to even pay off their debts. So this is a situation wherein it's like no bank will actually do this. If you go and take a loan from bank, they want to make sure that they have secured more collateral assets to service their debt. And I think that's the reason why we are seeing this upside down, because they have a less equity than their debt. It means in case if the business goes southwards, there's nothing left for shareholders. Even if you sell everything that you have in the company, still you cannot repay all your debts. So anyway, as a shareholder, we are at the the last in the queue when it comes to in the bankruptcy proceeding. But even if we are last, there's nothing left for us. So that's gives me makes me a little jittery about investing in this company. It has taken on leverage. As long as markets are good, it's fine. But if the markets turn south or if there is any weakness, that's not good because you have leveraged your balance sheet a lot. Okay. So I don't even want to now get into the balance and look at the valuation, etc. So I'll skip that sort of a section because I don't want to invest in this business. Plain. Okay. So that's a match. If you may want to invest in this and you think that this fine, let them take this leverage. I'm type of investor. I don't want them to leverage the balance sheet so much. Yeah. Maybe, if right now there is no equity left in it. Let's look at a retained earnings. How much do they have retained earnings? There's no retained earnings. They're all losses accumulated over years. So shareholder equity is completely almost wiped out in this one. Right. So I think you're right. Like they'd moved from, looks like, and I'm not invested in Math, but looks like Math used to be a good profitable company, right? They had extra earnings that they could just keep on their balance sheet. But I don't know what happened since 2020. Who ate their lunch? And it's been like a lot of losses that they accumulated in 2020. And since then, yeah, so I'm not interested. Maybe it was a good company, but I don't own this. I never followed this, but this is my 5 minutes view of this. So I'm not interested even to follow up on this one. Okay, so let's look at the other company. You guys like this? So I find that maybe doing this bird eye view helps me to even figure out, do I want to spend more time in this company or not? Rather than just trying to get through the details of it, first of all, I know whether it's even worth spending time or not. I also learn.
Thanks, Vivek. That was awesome. Just question, that was a wonderful spreadsheet. Did you manually create it, or is there a service that kind of does that for you?
No, so no, the service doesn't do it. This is what kind of I've been working on for the past few months, and this is like 37th version of it. Yeah, so I've been trying to figure out how do I make it easier for me to do analysis of any company.
Nice.
And
Nice.
yeah, probably I'll have a little more version of it a little later than, yeah. So this is something which I've been personally working on. During COVID, many had time to use other dating services that I matched into so well. Lots of my friends there was Bumble, there is Tinder. Oh, sorry, Tinder is owned by Match. This Bumble, I don't know. I was asking my daughter, she told me a few others, and I have no idea. Okay, MMYT, yes. Okay, let's do MMYT. All right, we'll go through the similar process on MMYT. Let's look at MMYT. So for those who don't know, MMYT is an online travel provider, operates in India. I don't know if they also operate outside India. When I was in India, yeah, I know I probably booked some tickets through them. Air ticketing, hotel package, bus ticketing. Wow, okay. They also do buses now. Provide the facility to book domestic, international. It's like a bookings.com or Priceline, but focused and operates out of India. They have makemytrip.com, Go Ibibo. I'm not using redbus.in. Okay, I didn't know that Redbus is owned by Make My Trip. Okay, so basically it's like a Priceline, right? And so let's look at how did they do. TTM 12 months numbers, P ratio, it is expensive, but there are, if it is a great company, you don't mind paying up from earnings perspective. Heg ratio negative, what they didn't have a growth, or maybe they had a negative growth. We'll see. PS expensive more from a sales perspective. Revenue 840 million, net income 290. So profit margin looks like net profit margin close to 25. 25%. That's fine. Market cap $10 billion, enterprise value 9.67. This is the reverse of what we saw in Match. So they have more cash than the debt, which is good. if they have debt, but they have more cash. So that's why market at EV is less than that, little more volatile than market. So you need to make sure you have a strong stomach to go through the volatility. What else? Nothing else. Let's look at, is it a compounding machine? 72% gross profit. Yeah, software company, capital light, then that should be the case. Return on investment 11%, not bad. No dividends. Operating margin 8%. I can't wrap my head around this. If it is a capital light software company, how come operating margin is only 8%? Right? What are they spending on? And then the net profit is 27%, which is even more surprising to me. So it means they have some income that they have generated, and I'm looking at only last 1 year, right? They might have some income that they have generated, which is not through their business ventures or general business operations. Business operations, which is what they're ticketing, hotel booking, bus booking, generated only 8.33% of operating margin. Little concerning to me from that perspective, because if it is it's just a online ticketing platform, then I would expect higher operating margin. So this is, we need to double check on it in terms of what's happening. What's the other income is coming from that? I think there is some other income that they're getting, which is helping them to have a show up 27% profit margin, where the operating margin of close to 8%. Revenue growing 32%, fine. Yeah, CapEx, it is a capital light business. Let's look at how Buffett would write it. Buffett rule rubric, all looks good. Tax looks like they have a negative tax, means probably they're not paying any taxes, or maybe they have a refund, which is fine. Retained earnings not growing. Cash to debt, yeah, so they have a lot of a cash as compared to the debt. So it means balance sheet is not leveraged, which is good. Revenue grew 31% year over year, which is fine. So I think maybe I can look further on this one, right? So this is, we're looking only at 1 year. So my concern is operating margin on an average 8% 1 year. Maybe something else happened in the year, which probably may not be the case year after year. So I want to give a little more benefit of doubt and see, okay, let's go back and 5 year and then see how they perform. Right. So now I'm looking at their 5-year value. P average for 5 year looks like they didn't have a lot of earnings, so they were sitting on negative. Same with the free cash flow, in any case expensive. Operating cash flow is 30%, gross margin 76%, operating margin average is negative 25%. Shares change, they also increase their share count. I'm looking at like 5-year average. Free cash flow yield is negative. Market cap has grown 23%, wherever their revenue has grown only 10% year over year. Over 5 years. So the market cap has grown much higher than what their revenue has grown. Yeah. Not always, too bad, as long as the company is, maybe the company is not growing revenue, but they are still able to manage their expenses well, buy back some shares, and increase the, the shareholder value. In that case, investors will, reward the company by paying up higher for the prices. But doesn't look like that they have bought back their shares. Even the shares have also increased almost 3% over the past 5 years. Right? And operating margin on average negative 25%. I do want to look at what happened over there. So operating margin is one thing I want to look at. And yeah, so I think it's time to maybe now dig deeper to figure out, even though they have a good gross profit, what's happening at an operations level, right? Before I discount this company. So let's Let's look at the revenue, and you see gross margins are all cool, right? 75%, 80%, etc. Operating income, on the other hand, is very less. They've been negative for many, many years, and I think that's what dragging their 5-year average down. But yeah, I could give them a credit for turning around their operations in last 2 years after many years of negative operating income. Right? So I'm not going to ding them to the fact that your average operating margin over the past 5 years is negative 25%, because, hey, yeah, they were bad in managing it, but now they become much better. Right? So maybe if this could this be a turnaround? Who knows? But looks like it is moving in the right direction. Of course, net income have been all negative. Yeah. So share-based compensation, long-term liabilities, balance sheet is okay. They have, $600 million cash on their balance sheet. So this company, this is a kind of a turnaround story to me, it looks like, from a business perspective. And if it is able to turn itself around, yeah, maybe you could look at and then see, do you want to invest in this or not? So let's see from a valuation perspective, what does it look from a valuation side? Right? I don't know. Should I even look at valuation? Because this is still a company that is turning around. So their free cash flow may not be reliable right now. So maybe I'll skip the valuation to see, is it really worth trying to value the company when I don't have a good trend of their free cash flow for a longer period of time. Right? Because it's been all over the places from negative to positive. They've only had 2 years of positive free cash flow, not much of a trend to project. So this is a turnaround company. And if you are interested in investing in the companies that may be able to turn around their business, then you may want to look at this company. So that's my quick thought on this one. But anyway, looking at free cash flow for past 4 years, 4 quarters have been, like, I'm looking at TTM 165. Let's say they paid $165 million free cash flow, little more risky, so I want to discount them higher. Revenue growing at 10%. Let's say if I give them are the analysts following this? What's the analyst growth expectations? Revenue growth 13%, EPS growth 12%. I'm going to be more generous and say, okay, you're going to grow your free cash flow as much as revenue is growing. Still, it's right now super expensive. Now, this is purely based on the last 4 weeks or last 4 quarters of the numbers, right? If a company performed great, it could grow into this valuation, but right now trading at $92. Whereas if you try to run your, how much, so this basically tells me, let me put it this way, that for it to be $92 from a cash flow valuation perspective, it might need a growth rate of growing their free cash flow by what, 26%? Yeah, 26% year over year for eternity, right? Not just this 1 year, but for eternity, they need to grow their free cash flow by 26% year over year. Will they be able to do it? I've not seen many companies doing that, right? Maybe this is the greatest company on the earth, but do you want to bet based on that? Maybe if you want to do it a small amount, but it's currently at this valuation is super high, especially when I don't know if they will be able to continue grow their free cash flow like they have done it earlier in last 2 years or not. Number two, specifically I want to be a little more cautious of the companies that have grown their free cash flow only last 2 years. Why? Investors started demanding it. Why is Facebook paying dividend? Why is Google paying dividend? Because investors started demanding it. Right? So maybe they've done something only for the last 2 years just to figure out how to get a free cash flow, and company may resort to the same behavior once the pressure gets off them, and the investors become little more risk takers. And again, I don't know, I'm just speculating it. Right? If they have become wiser in the last 2 years and will stick to the wiser behavior, yeah, then it could turn itself around. Yeah. So that's on Make My Trip. All right, maybe whoever asked for lettuce is not there, so I'll save time. But yeah, now let's take a list of next week. And if you like this quick bird eye view, okay, Sri says please review LSCC, or let's do it LSCC. Let me bring up LSCC. LSCC. Okay. And yeah, keep your list ready. Maybe we can do 5 stocks next week also. So for whatever first 5 comes in the chat, I'll take note of that. So put in the chat if there are 5 stocks that you want me to review next week. Okay, LSCC, it's a semiconductor company in FPGA, field programmable gate arrays, I guess. So let's look at how they've done last trailing 12 months. PE ratio is high. It's a semi company, right? So anything in the semiconductor is super expensive. Even forward P is higher. PEG ratio 3.18, that raised my antennas up. Anything above 2, and again, that is Peter Lynch's criteria, that anything around 2, above 2 is, you should be a little cautious. But I'm not gonna, run away from the company just yet. It is just one data point, which I know, and maybe I should mark it as a red, saying, hey, I need to reconfirm why they are so expensive. 10 PS ratio, that's fine. Revenue, almost $700 million. Net income is $200 million. Yeah, close to 20% plus net profit margin. Debt to equity, I love this. Not much of a debt as compared to equity, unlike Match, wherein they had no shareholder equity. Shares out. Market cap is 7.57. Enterprise value is 7.46. So yeah, I mean, no debt. A beta 1.38, little more volatile than market. 52-week high is 98. 52-week low is 51. Where is it trading right now? I can now delete this. It's 6% off their 52-week below, and 44% off their 52-week high. So 52-week high is 98. So right now it's trading at $55. So pretty close to 52-week low. Okay. Gross profit looks good. ROI, this is a great returning good return on investment, which is I like it. It's okay. Inside ownership 6.91%. That's fine. Its company has been around for what, 30 years. So you get diluted. It's not a new company in which I would want founders and insiders to have much bigger stake. It's been around for 30 years. No dividend, that's okay. Operating margin on average, 24%. This actually makes semiconductor. It's not only software company, and still almost 25%. Yeah, I mean, that's not bad. I won't like 25% operating margin for a pure play software company, but this one, I'm okay with it. And profit margin 30%, which is fine. Revenue, so they are not growing revenue last 1 year, which is okay, not that great. All right, but maybe something could have happened in this year. Okay, so I need to look at revenue growth, what they did here. EPS also is not growing, so they're not growing their EPS. So these are the two concerns. CapEx, not highly capital intensive. as compared to revenue or operating cash flow. It's fine. And they have some real free cash flow, not entirely sponsored by stock-based compensation. So that's good. 5 years, so looking at, okay, retained earnings, they're not growing, but it's okay. Even if they keep the retained earnings same, it should be fine. But looks like something has happened this year, that the revenue is down, EPS is down, retained earnings are down. But let's give them a benefit of doubt, look at last 5 years of data. Even for 5 years, they've been pretty expensive. P ratio 77. Even on the free cash flow basis, 54. So one thing is very clear. Currently it is trading at a pretty expensive valuation as compared to last 5 year worth of data. It may be because it's only in the last 1 year or 2 years we are seeing the valuations of all the semiconductor companies have gone really, really high. A free cash flow yield average is only 2%, not that great. Gross margin 70%, which is good, but they've been able to maintain good return on capital. Shares changes, yeah, they've been buying back some shares at least, so which is good. The share count has come down. The market cap has been up 61%. Okay, so now this is little concerning to me. So revenue was down 6%. So let's look at and see what they've done over last 5 years. Revenue grown only 1%. So now this I am little concerned about, that over last 5 years you haven't been able to grow your revenue. I mean, you've grown your revenue at a CAGR of just 1%. That doesn't sound that great. Whereas your market cap has grown at a CAGR of 60%. It means either you should be managing your expenses, etc., to generate a huge returns for shareholders, because the market cap is already accounted for like 60. It has grown at 60% CAGR, whereas the revenue has grown at only 1%. As a company, you can only cut down on your costs up to a certain level, right? You can do a bare bone. You can't go down below that. You're going to kill your business. So to me, it looks like not a growing business. So I want to reconfirm that. Let's look into their annual report. Now, if we look at their revenue side of the house, 480, 500, 550, 555, 626, not that great, right? I mean, it's kind of, it's actually going down. Maybe this last one, 2023 is going on, but it's not growing like gangbusters. Like the market cap would suggest you that, it's growing. So I am a little concerned on that one, from the revenue perspective, that the revenue isn't growing as fast, or rather now it's actually plateaued and it's not going down. So that is a real concern for me. Share-based compensation, they have increased, but it looks like they are also buying back their shares. So outstanding shares have reduced a bit, which is fine. Balance sheet on an average looks good. And I'm only looking at last 10 years. Operating margin is just following the same curve of revenue. Same is the case with the net income. So my concern is on that there's not much of a revenue growth. Maybe it is because it's in a niche area of FPGA. And now you need to look in and see what's the growth expected in this industry. I don't know much about the industry, but I know that FPGA was supposed to be, will have a higher growth if we have the whole 5G rollouts and all that stuff. And yeah, so I'm a little concerned on the revenue side. Not much growth left in the company, but okay, if it is available at a very cheap valuation, why not? Maybe I'll buy it if it is a cigar butt investing. So now let's look at a valuation. Okay, pretty expensive, and still giving a benefit of doubt, I want to look at Last 4 week, like 4 quarters, 227 million free cash flow. Analyst expectation of revenue growth is 5%. EPS growth is 10% because, hey, they're going to cut their expenses and grow their cut expenses, buy back shares. You're going to grow your EPS faster than revenue. Okay, I'm giving them a benefit and say, let's first see how much of a free cash flow growth has been accounted for in the current share price. Okay, so let's do 10%, 12%, 13% free cash flow growth is required from this company to grow into current valuation. Okay, now that doesn't mean tell you anything around what the stock price will be, but if you want to look at the fact that the valuations of the company should be equal to the total amount of free cash flow they generate in the lifetime discounted to the present value, it needs to generate its free cash flow by 13% year over year. Could it? Or could it not? Is a question. Over the last 5 years, it has generated at a CAGR of 39%. If you look at free cash flow, even though the revenue has not been growing, their free cash flow has been growing nicely. Because they may have been cutting their costs. So let's look at their cost side of the house. Operating income, 141, 163 has been generally okay, but net income is growing faster than their operating income. Right? So they've been able to generate some free cash. Let's look at free cash flow after taking care of stock-based compensation. Yeah, still, I think nice. They will able to generate their free cash flow at a higher rate than what they have been able to generate their revenue. Now, bigger question is, revenue is expected to grow at 3%, EPS expecting to grow at 10%. In that case, analyst is expecting that growing your free cash flow at 13% seems to be a stretch. So maybe I'll buy this company if it is available at a cheaper valuation. I think 13% is stretch for them. Maybe if I give them 100%, EPS growth and the cash flow growth will be the same. $45 is the value of the company. Okay, value of a share. Now, if you want to give yourself a little room for error, you decide what the price point you want to pay. That doesn't mean that the stock could not go to 60 tomorrow. Okay, don't get me wrong. Stock price and the valuations are two different exercises. All right, so that's my thought on Lattice. I don't own this company. In fact, I don't own any of the companies that we reviewed so far. Yeah, I think I should give the disclaimer if I come across a company that I own. All right. So I did get a list of some companies, FLYE. Okay, I will ask you one more thing. When you give me the company ticker, also give me the name of CEO and the market cap of that company. Okay. You need to tell me along with that, what's the name of the CEO and what's the market cap of the company. All right. These tickers is fine. From next week, I want to force that exercise because it will force you to at least look for it and you'll find out something that might interest you around that company. And these small things help because again, I learned from my experience last year. I decided that for every company that I own, I need to know who's the CEO. When I search for the CEO name, I get across some news of the company. Then I realize, oh, this is happening in my company. So I just want to force you to know the market cap because when you're buying a share of a company, per share price means nothing. We always have to look for what I'm paying up for the company. What's the total market capitalization of the company? Always when you're buying a stock, always look from total market capitalization. $10 stock can be more expensive than a $50 stock. And we'll only get into that habit if we always view the company from market capitalization perspective. So I'll force you that when you give me the ticker, give me what's the market cap and who is the CEO of the company. Okay, from next time. So I got FLYE. Let me take a note of this. FLYE, CRWD, AFRM, AMD, and VKTX. I'm going to do 5, but I'll take, okay. So ALGN, that goes on the number 6, Uber. Okay. Shri, that's a great forcing. The reason is because I realized I benefited from it. So I thought AMD Meta. Okay, guys, I got more than 5. So we'll do this 5 next week. Looks like you like this exercise. This is the first time we're going through this exercise, so I thought, why not? Let's do a quick earnings review, or maybe let me go through that article that I really want to go through, which is more around investing minds. Let's look at earnings next week. Which earnings are coming up and what am I interested in? On semi, this is semiconductor, nothing on Monday morning. Okay, Lattice is coming up. Since we just talked about Lattice, I am gonna look at Lattice and see what they're doing in their earnings. PayPal, I own PayPal. Oh, come on. It's because I'm gonna go through PayPal because I own it. What else? Microsoft. Oh, it's gonna be. We got a Microsoft. I got Pinterest. Both I own, so I'm gonna look at those. Wednesday we got a Boeing.
You don't know AMD?
I don't
Okay.
own AMD. I don't own AMD.
And Sophie?
SoFi, no. SoFi I don't want to own. I think long back I talked about, I was not really happy about their accounting and how they account for the loan on their balance sheet is like little bit more of an Enron like accounting. You can put whatever value you want to. Number 2, yeah, so I'm not keen on SoFi. I haven't got a reason to invest in SoFi just yet. What else? Meta. Oh, they're doing on Thursdays, Amazon, Apple. Okay, so Mercado Libre. Looks like next week is going to be a very busy week for me. A lot of companies that I own, and probably they are all my top 10 holdings, are going to report the results next week. So depending on how the results come out, you'll see me if I'm going to be cheerful or I'm going to be completely the blood sucked out of me. I'm just kidding. It's okay. Doesn't matter. One earnings doesn't define the company, so should be just fine. Sam asked, possible to get the recording. Sam, the recording is there on the website. You guys know, so it's also available. You know, if you just go to weekend webinars, and yeah, I have all the recordings available here. So it takes me a few days before I, put it up. But yeah.
Vivek, one quick thing. So already we saw 3 fangs already going down, 3 more pending. So it looks like Nasdaq is super bearish. What do you think? Like, are these overvalued? 3, the rest of the 3?
So no, Amazon, I don't think so. Apple, I think, because all the valuation of Apple recently was around their AI stuff, right? So, but I'm not going to. But here's the thing, right? Overvalued in a short term doesn't mean anything. I can't discount a company that has got that generates $100 billion of free cash flow every year. So, in euphoria of AI, have some of these companies been overvalued by the market? Sure, that is possible. But is it the fact that these companies, are not worth much? I don't think so. So that's my case. And again, these are not the companies like .com companies, which did not have, forget about, profits. Even some of the companies didn't have even revenues. Some of these companies are generating good amount of revenues, right? Good amount of cash flow. So let's dig into Google. So we'll know in terms of what Google has done. Google stock was punished after the earnings came out. So let's see, is it really? So what Google did? The revenue was up 14% a year over year, gross profit up 15%, margins, again, they're improving their margins. And again, these are the companies which are generating like 80-90 billion dollars per quarter of revenue. On that basis, you're still growing at 15%. It's still a good growth. I'm not talking about a company that is like growing $100 million of revenue, and then it has grown to 115. If that can grow to $150 million, right? That's fine. These are the company which is generating $80 billion of revenue per quarter and growing it at 14% year over year. Operating income is up 26%. Right? Margins are up 3%. These are like $2 trillion or $3 trillion companies. I don't know what, where is Google, right? And they're still generating and increasing their margins, right? So I have nothing to, net income is up 30%, almost 30% to $23 billion. Okay. EPS is up 31%. So I didn't see anything which is of a huge concern to me. Free cash flow, you can say it's down 38%, but that's okay because they're investing in they're putting capex to build the capabilities for all this generative AI, and all that stuff. So I'm not bothered about down in free cash flow and cash equivalents. Even if the cash they have to spend to increase their capital expenditure, still $100 billion sitting on their balance sheet. What are you going to do with $100 billion? Damn, invest it. And that's what Google has done. Invest in your business to ward off competition, to build in the capabilities for your, next big line of business beyond search. So cloud revenue up 29%. Google is distant third, and they are growing at a faster pace than AWS. Still, they have a lot to catch up. They're up 30%. YouTube ads up 13%, right? Which is, I think, less than what the markets were expecting. Number of employees is down. Advertising is still up 11% year over year. What happened to the whole fact that, Google search and Google advertising will be disrupted by a whole ChatGPT? No one will be searching. Why would anyone want 10 blue links? So far, it hasn't shown up in the results. They still grew their advertising by 11%. Network ads, however, went down 5%, but that's a smaller portion where you show banner ads because maybe folks are not clicking that much. They're getting the generative AI results on the top. They may not have to go, but that's a smaller portion of the business. Right? Good thing is operating income on Google Cloud for the first time surpassed $1 billion of operating income on Google Cloud. So it is now try to become the margin, the profitability picture of Google Cloud is improving. YouTube ads grew 8%, 8.59% to 13. Okay. So previous quarter comparison, CapEx is higher than what is what market was pricing in. How much higher? It's $1 billion higher, right? Market was pricing in $12.2 billion. They did a CapEx of $13.2 billion. Advertising revenue was higher than expected. YouTube reported little lower revenue than what the market was expecting, but I don't think that's a huge concern to me just yet. Right? Still, YouTube is what, $32-33 billion run rate a company. It's like a company in itself. So what else? Google Cloud, operating income above more than $1 billion for the first time. Revenue from Google Cloud exceeded $10 billion for the first time. But like I said, everything looks good. Market punished Google for two reasons. Number one, the capex. Number two, around the revenue on YouTube was less than expected. I don't think any of these two things are bigger issues. Google doesn't invest in capex. Market punishes it because, hey, how are we going to catch up with the AI? They invest $1 billion more. Market punishes it. Oh, you're over investing in it. Come on, this company has $100 billion sitting in their bank. What $1 billion means. So I think I'm not too concerned about Google. There was no info on guidance. They're going to pay some dividend. Management says, I think he mentioned somewhere. Okay, I don't have that quote. I think what he also said that there is a bigger risk of under-investing in AI than over-investing. So I think they'll be okay to over-invest for now to capture the market and OI, then be left behind. Now, I myself think that there's too much investment going in AI. We don't have a profits to show up. But can a company like Google afford to do it? I think with their balance sheet, yeah, I think they can still afford to do it with their balance sheet. Yeah, trend was all look good. Now, long-term story is still good. I think cloud and YouTube will still have a runway, very low debt. The only concern I have was around the Wiz acquisition, because they are number 3 behind AWS and Microsoft. And Nova talked about Wiz acquisition in the call, but I've not seen over the last 6 months Google trying to acquire 2 companies. My only concern is, even though it can afford it, are they becoming desperate? So they try to acquire HubSpot, saying it's going to be bolt-on acquisition on their, with their search businesses. Eventually didn't pursue it. Now they try to acquire Wiz for $23 billion, which is like super, super expensive. Why? Are they becoming desperate? That's my concern, that are these acquisitions going to be value destructive for investors because they want to close the gap between themselves and the Microsoft, and maybe trying to acquire the companies at much more expensive valuation just because you can afford it. Right? That will be my concern on Google. If you can afford it, doesn't mean throw the money around. Market is overreacting for Search GPT. Yeah, Search GPT was also released, but that was released, I think, on Friday or Thursday. Prashant says, in my honest opinion, Google downward correction is still pending and will change view if price reverses. Yeah, so I don't want the narrative to follow the price, which is unfortunately what happens in the market. The narrative follow the prices. If the stock price goes down, suddenly analysts will come up with all the explanations of why it is down. If the price goes up, all analysts will give you another explanations of why it's a good company. Come on. Tell me before it goes down that it's a bad company, or tell me that it's a great company before it goes up, right? So that's on. I think I'm not too concerned, but is this? I didn't look at what valuation is Google trading right now. So let's look at its valuation, right? P ratio is 24, right? Still, I think it's cheaper than, or maybe SPY is at where? I think SPY is also 24, 26. Not that expensive as compared to the rest of the market. Right? So from an earnings perspective, cash flow side a little expensive right now, but that is okay because they're investing all this cash into the market. So from a valuation perspective, it's not super, super highly valued. Just so I think I'm still okay with Google. 167. Maybe at 190, the things could have been different. But at this point of time, it's not super overvalued. Now, the market could also, and we have seen market throwing baby along with the bathwater when there is a concern or recession or whatever, when the markets are all going down. But in that case, maybe they'll punish it. That's fine. But just for me, the long-term story of Google, I think still fine. So that's there was a question on FANG. I know Google. I'm not too concerned about Google. All right, a quick look into crypto.
I think you didn't cover Tesla.
Tesla. Yes, thank you. Let's bring up Tesla. Tesla, does earning even matter? Because Tesla stock goes on what Elon says. But let's look at Tesla. Okay, so revenue up 2%, gross profit of 1%. Now we are Tesla was supposed to be a software company having wheels underneath the computer, but growing a revenue of 2% only, and a gross profit of 1% only, means the growth is slowing down. Margins are down. Operating income is down. Operating margins 6.29%. That doesn't look to me like a software company. What was Google operating margin? Let's look at, I forgot. Google's operating margin was in this quarter is 32%. That is a software company. That's why match 8%. I don't like that. Or make my trip 6% operating margin. There's something else in the business. Is not purely a software company. Anyway, Tesla's operating margin 6%. Okay, net income is usually down 50%. That's why market didn't like it. EPS is down almost 46%. Market punish the stock. Why do we have a lower margin? Reduced pricing of their vehicles. Like that's the average selling price was reduced because of all the competition that we are seeing. Restructuring charges. Okay, I'll give you, this is a one-time cost, not a recurring cost. Increase in operating expenses largely driven by AI projects, right? All the investments that is doing in buying NVIDIA chips. But I don't know, some of the NVIDIA chips, they diverted to XAI. And the decline in vehicle deliveries. So you're kind of getting hit on both sides. Number one, the vehicles delivery is declining, and the average selling price of the vehicle is also declining. Right? So you're getting hit on both sides, the revenue as well as on the margin side. Compared to previous quarter over quarter, like revenue grew only 2%, gross profit only 1%, operating income is down 33%, margin picture last 4 quarters has been like a single digit operating margin. This is not good. I mean, we used to hail Tesla keep it on very high on pedestal and say, hey, look at those traditional automakers, 5% operating margin. Tesla used to have a 18-19% of operating margins. Not anymore. Now they are back, they are single digit operating margins, right? What else? Share-based compensation has plateaued, which is good. Good thing is, it's the highest ever revenue in the history of the company, quarterly revenue in the history of the company. Even though the revenue hasn't grown much, but of course, this is the maximum revenue that they have generated. Now, how did the revenue come from? Right? Look at the composition. Automotive revenue is actually declined year over year. That's not a good scenario. Tesla generates most of their revenue from their cars. That's the whole story, right? Hey, all these great fancy cars. Now we are seeing that the revenues declined 7% year over year, but energy storage and generation is up 100% year over year. And the carbon credits, the other stuff is up 21%. Now the question that you need to ask yourself is the Tesla story changing? Elon says that the Tesla is not a car company anymore. It's a AI company. And he in fact said during the conference call, it's all about autonomy. Forget about how much dollars we are generating from automobile. When I talk about AI, I talk about autonomy. If you don't believe in it, don't hold Tesla shares. So now you have a new story that you as a shareholder need to be comfortable with, saying it's all about robotaxis and maybe Optimus. It's not about selling EVs anymore. It's not about growing your automobile revenue. Is it because Tesla thinks that they no longer be able to meet their 50% growth on their automobile, that the target that they had set earlier in terms of deliveries? Maybe that's the case. So you have to change the story. Right? Now the management is telling you, forget about Tesla as a car company, or don't value Tesla on the automobile revenue, but talk about autonomy, the stuff that doesn't even exist. It's not the first time that Elon has done it. And sometimes he's proven himself right. So that's a concern. Automobile revenue is down. Now, energy generation is basically, and the carbon credits has helped Tesla in this particular quarter. So let's look at some management commentary. FSD 12.5 will be much better than 12.4, which is what they call as a full self-driving. Robotaxi event has been pushed out from August. As you guys know, he told that it's not going to happen in August anymore. That's why the Tesla shares were punished. Gave a new date of 10/10 in October, where they're going to give us more details on where the robotaxi is. But I'm a little more concerned on the robotaxi itself. I mean, eventually, how big is this robotaxi market is? There's some study that says that currently, if you look at Uber and or the DDs and all the big tax ride-hailing companies in the world, and there are some projections that even if we consider that the market is going to grow 90% year over year, the overall the revenue will grow from, I think it's around $50 or $60 billion it is currently, to maybe $500 billion by 2030. Right? For $500 billion in 2030, Europe, I don't know how big, and let's not assume that Tesla is going to capture all 100% of that market. And even if you give, let's say Tesla gets 10, 20% of that market, so maybe it's additional $100 billion of revenue. You give it 3 or 4 times the price to sales valuation, maybe add another $300 or $400 billion, right, of the overall valuation. It's nowhere, like trillion of dollars that ARK, those researchers on Cathy Wood's team will talk about. I don't know where they get their numbers from. I don't know what they smoke to get. It's like this could be robotaxi, could be worth trillions of dollars of valuation. In any case, we're no longer there. We've been hearing about this autonomous driving robotaxi since 2016. I wasn't following Tesla in 2016. Only first time I heard about robotaxi was in 2019. wherein he told that we'll have 1 million robo-taxis on road in 2020. Or was it 2020 and said million robo-taxis in 2021? I haven't seen even one yet. Forgot about 1 million robo-taxis. Optimus V1 is in limited production starting next year in Tesla, in basically for its own in-house consumption. Energy is growing faster than anything else, ramping up production in US factory and building factory in China. So maybe energy will be, we should value Tesla as an energy company. And they also said that we're going to be advertising, because 66% of the sales in US were to customers who are new to Tesla. So it looks like they need to basically create more awareness so that more people can buy more Teslas. Even it may not be because you don't have to advertise it to the people who are already your customers, right? You need to do brand advertising to those who are not, and looks like it is helping them. So they're gonna focus on advertising. Yeah, quarterly performance. I mean, the revenue kind of stagnated to going down. Cash balance is increasing nicely. Concern is its margins. Look at the margins from up 15%, let's say 10 quarters ago, is down to now 5 or 6%. You're not the what changed in last 10 quarters, which means 2.5 years? Competition. Your margins will be competed away. That's what Jeff Bezos says, right? Your margin is my opportunity. Right? Similar, today I'm seeing that with NVIDIA, right? 60% margins will be competed away. It's only a matter of time. Stock was down 8%. Here's my take. Highest ever revenue quarter, which was good. Operating margins continue to go down because of heavy investment. Now the margins are less than 10% for 5 consecutive quarters. It's now a normal car company. I can't value it as a software company with the less than 10% operating margins, right? Stock-based compensation is plateauing, which is good. Earning call was very boring. Some said that Elon didn't sleep a night before because he was giving some interview. I don't know what the reason is. They're completely out of energy. The new CFO can put you to sleep, and was so boring. So Tesla is like a high potential teenager. It could do wonders because Elon Musk is still at the helm, but if it puts mind to the right things. And right now there are too many things going on with Elon. So it's a teenager. So make sure you invest it accordingly. It's not a mature, it's not behaving like a mature adult right now. It's too many things, keep changing the stories based on what's working or what's not. Now the new story is it's a AI and the autonomy and robo-taxis. I own Tesla shares. I own Google shares also. I've not gained enough confidence to add a current price point at 226, right? Maybe it is below 200. Yeah, maybe I'll add a little bit more, but yeah, not too. This earnings call, this quarter earning call didn't give me too much of a confidence. So it all depends on what he's going to talk about during October. It runs more on sentiment and what Elon has to say than what he actually does. Eventually he may do it, which we have seen. All the credit to him. You can believe on Elon, on his vision. Just don't put your faith on him to meet the timelines, right? So if you are, that's the issue with him. So that's Tesla. All the Tesla bulls, those who thought that we're gonna give us some insights into robo-taxis, were a little disappointed during the earnings call. Nothing much came out. EPS down, margins down. So it was not a great earnings call. Renesas is that a Turkish company, right? Or maybe a different one. So, all right, we got 7 minutes remaining. So maybe we'll do quick crypto one and then we'll call it done. Or maybe let's go through that article that I also, or we can skip this. Talk about predictions. And then we'll call it done here. Okay. All right. What happened? Okay, yeah. So I thought maybe I missed something. So this is good learning. Again, this is first thing. I mean, being uncertain is good as an investor. If you saying that I don't know or I'm not certain of it is good. That's why I want to sell options and not buy it, because if I buy it, then I'm certain this is how it's going to be. The stock has to go down for me to make money, or the stock, if I buy put, or the stock has to go up for me to make money if I buy calls. No, being uncertain and avoid using the terms that it will, I won't, I always, never, we should take out from your dictionary. And if I'm using these words, correct me. I'm learning and trying to use the right words to build my right mindset. I'm not going to say I'm never going to invest in Tesla. Just that this valuation doesn't make sense to me. Right? I'm not, maybe Elon will deliver it, then I'll change my mind. Right? So always give yourself room for error, margin to be wrong, especially when you're investing. Nothing is worse than certainty in investing. And because we've seen time and time again, those who are certain about the things, I mean, that really doesn't work out. Let's talk about a couple of degrees of uncertainty. And I got bitten in 2016. And this was like, and that's why I started exploring options. What was the overall, majority of the opinion was Hillary Clinton will win, right? And if by any chance, if Donald Trump were to win, the market would collapse. The least certain pundit said was Clinton was 80% likely to win, and estimates of her probability were always more than 80%, minimum 80% probability for her to win. And who won? It was a Trump who won. And when Trump won, and I distinctly remember, I was super scared. I'm like, everyone's saying market is going to go down. We are talking about 2016. And I'm like, gosh, how do I protect my portfolio? I sold 1/3 of my portfolio. And then Trump won and the market went up. I'm like, what the heck I did? Right? That's where I'm like, I need to figure out how to stay in the market, not get scared out of the market. How can I protect? And that was my reason to start exploring. And I came across options, and ever since then, I've not got scared out of the market. That's why now I'm approaching what 8th year, because that was my reason. I sold 1/3 of my portfolio because everyone says Trump is going to come, market will crash. And then the market went up like 30% for 14 months. So two things. Number one, we don't even know what's going to happen. So today, everyone, now we've already priced in that Trump is going to win. I also say, someone asked me like, come on, Trump is going to win. But at the back of my mind, I'm like, let me make sure that what happens if Kamala wins? Like, what happens if she emerges to becomes the president of USA? And we need to think from that perspective also. So number one, we don't know what's going to happen. Number two, we also don't know how the market will react to what actually happens. So in this case, we were wrong. The pundits were wrong on both sides. Number one, Clinton will win. Number two, if Donald Trump wins, market will crash. All the pundits were wrong on both degrees of uncertainties. So even if your prediction comes out to be true, in this case, the prediction didn't come out to be true. What I'm saying is, if you think that the GDP is gonna, the stock market is going into recession, right? 2023, everyone, all the pundits were saying stock market will be in recession. Let's say even that didn't happen. Let's say even if the stock market is in recession, you still don't know how the the economy is in recession, you still don't know how the stock market is going to react to it. So why even try to predict it? Why even base our investment thesis on macro stuff? That's the reason why I stopped discussing macro in these sessions. Multiple instances of macro forecasting gone wrong in recent time. 2021, all the PhDs that Federal Reserve had saying that the inflation will be transitory, right? We know what happened, not at all transitory. 2022, everyone was certain that if Fed increase the interest rates, it will precipitate a recession. We didn't see a recession. Late 2022, the market consensus was inflation was easing. This will permit Fed to start cutting rates, and the rate cuts would enable economy to avoid a recession to ensure any contraction will be shortly. So basically, at the end of 2022, we were talking about 7 rate cuts. Oh, sorry, that was end of 2023. So this optimism, okay. Yeah, so inflation was easing. This will permit Fed to start cutting interest rates. That hasn't happened yet in 2022. Number 4, yeah, this one was right, which market was pricing in. The hard mark says 6, but I remember talking about and listening that there were 7 rate cuts that we were pricing in at the start of Jan of this year, right? Then that became 5. Now we're talking about 1 or 2 rate cuts. Hasn't happened yet. This all serve as a reminder that we don't know what's going to happen. And if by chance, by luck, what we think actually happens in the economy, still we don't know how the market is going to react to it. So
a question on interest rates. So if they do go down, do the bond prices go up?
If interest rates go down, the bond prices, yes, they will go up.
Yeah.
But I'm not talking about, we don't know how the stock equity will react, but the bond prices will go up.
Yeah, yeah. So if there's a 90% chance that the interest rates would go down, and they might not, now might be a good time to consider bonds.
So the question is this, has bond market already pricing in and pumped up the price? That I don't know.
Right.
That's a question that we need to ask. That we don't know how much is already priced in. But if you really look purely from mathematical perspective, if you have a bond, which is, let's say, 5% yielding bond, and now the prevailing rate has come down from 5%, the current value of that bond will go higher. Right? That's because you can't have an inefficiency. Those inefficiencies will be competed away. The price of the bond will rise up to make sure that for the remaining period, your return is still same as what the lower return in the market is. That's why the price of the bond will rise. That's just math. Now, how much of that prices have already pushed out? Who knows? Right? So stop focusing on macro. One can be right in predicting macro factors and yet lose the market. Right? A rare person who in October 2022 correctly predicted that the Fed won't cut interest rate over the next 20 months was absolutely right. That Fed is not going to cut the interest rate. And it's right. Fed didn't cut the interest rate. And if you stayed out of the market saying Fed is not going to cut the interest rate, so why would I stay in the market in October? You know what happened after October 2022? Markets have ripped higher. So even if you were right in your forecast, you still lost a lot of money. Or you didn't make anybody, you lost a lot of opportunity. On the other hand, if you were optimistic about rate cut, right, and you were absolutely wrong about it, you're much richer today. So you could be right and lose money, or you could be wrong and still make money in the market. So don't try to even predict what's going to happen in the market. Unfortunately, there are many gurus and the pundits always be on the financial media trying to predict where the market's going to go. Neither they know, nor the host have any idea. But the one question which pisses me off always is seeing the host talking about what's your prediction for the S&P? I'm like, what? You know, everyone's prediction can come right once in a while. Tell me someone who has been able to predict it consistently. Market over a long period will follow profits. This was, you know, even despite all the swings and all that stuff, 40-year standard deviation of annual percentages. GDP, 1.8%. Right? This is for our US markets. Corporate profits over the last 40 years have, you know, 9.4%. S&P, 13.1%. So movement of the market is little more than the movement in the corporate profits. So that's why the market's a little more volatile. And that's the price that we have to pay if we want to invest in the market. And the reason why the markets are more volatile, because we are all humans. We swing the pendulum to one side, always to the extremities, right? Everyone is euphoric, and then everyone become desperate in when the times are not good. No one behaves rationally. I mean, do we say the efficient market theory says that everything is... I used to be a believer in efficient market hypothesis. That means everything is priced in the market and everyone behaves rationally in the market. But after being in the market for many years, I realized, oh, that's not the case. We don't behave rationally. Rational behavior is if the stock that if the company that you have holding in your portfolio, you like the business of the company, that goes down 10%, 20%, we should be buying more. Yeah. Very difficult thing to do. We don't buy more if it is on sale. We in fact sell it. So that's not a rational behavior. So there are about forecasters. Last thing around forecasters, there are only two kind of forecasters. Those who don't know, or those who don't know that they don't know. Right? We all know the people who will describe as often wronged. Often they are wrong, but they are never in doubt around what's going to happen in the market. Right? And last line, Mark Twain said, it ain't what you don't know that gets into the trouble. Especially very true about the markets. It's what you know for sure, but that is just ain't true. So now onwards, don't be sure. And structure your portfolio, structure your trades, thinking that you can be wrong. So to put simply, intellectual humility means saying, I'm not sure. I have a higher probability, and that's why once you start dealing in options and doing probabilistic trades on options, looking at probability of profits, you'll start, at least for me, I started change my general life behavior also is, I don't know if I'll be able to reach at that time or not, but I think it's a 90% probability that this will happen. So words that we need to include in our dictionary, in our lexicon is, I'm not sure. I could be wrong. I have a higher degree of probability, and remove the stuff like, I'm sure this is a good company. I'm sure the stock is undervalued. I'm sure I can reach there in an hour. I have a higher degree of confidence that I'll reach there in an hour, but I could be wrong. So we may be able to sub-optimize when the times are good because I didn't load up. I didn't leverage because I'm not sure. But you will avoid the ruins in your portfolio. And when it comes to investing, last week we talked about investing is amateur tennis. If you avoid the costly mistakes, Market generally has upward trend anyway. It will take care of it itself. How do you avoid being melted down? How do you avoid ruining your portfolio? Is never get too cocky, never get too sure of yourself, because PhDs in economics can't get the stuff right. So what you and I can talk about it, right? So that's why when I say, what do you think about this company? I can tell you what my thought process is. I could be wrong. So new words we need to learn is I could be wrong. With that, let's end it here. Last topic, I'll just give you a quick update. I bought Arista Network. We looked at this company. No, I ran it through those whole bird eye view. Looked to be great. Passes on almost all the criteria. So I dipped my toe in it. Now, next step I need to do is go through its annual report, maybe go through last few quarters of earnings, run through the deeper evaluation criteria that I use for for company if I want to take a position, and then add to it if I really find on a second level of investigation that it's a good company to build position on it. But if I may, as a last one, if I can show you why I built position on Arista Networks, is because of, come on, just load up Excel. All right, all looks good, right? High quality compounders, all look good. This growth, it is expensive. Only thing that turns out to be red is, damn, it is expensive. Business wise, it looks to be good. 1 year, 5 year. If I look at Buffett criteria for 3 years, all looks to be good. So when market gave a little bit opportunity, because all the stocks were down, I thought maybe. That's why having a watch list helps. So I dipped my toe in it. And now I'll spend more time in reviewing the company, run through the more detailed rubric, and then I'll see if I want to continue building position. Sold, Stoneco covered call got assigned. I'm no longer want to defend it or hold the company, so it's fine. That got sold. All right, with this, we reached the end of a session. 10 minutes over. Gosh, I thought I'll finish in 2 hours. I need to rush. All right, anything else you have for me? Maybe one question?
AMD.
I'm not gonna go through the AMD. Did I not take the list? The AMD. So I'll go through AMD. Yeah, next week.
Tuesday is the earning.
Oh yeah, earnings is coming up. Yeah.
Okay.
Maybe I'll do a summary of earnings. AMD earnings.
You said Amazon valuation is like not that overvalued like comparison to Apple, correct?
Google, Amazon, I have to see. Amazon generally over the time is not cheaper valuation, but I have to see on Amazon where it is right now.
I see. And last question, Meta, do you think is like cash at hand company still overvalued?
Meta, I like Meta. Yeah, I like Meta.
I see. Okay, sounds good.
They also open source their next version of Llama, in which I think they're gonna give a good. They're not gonna make money from Llama as right now, but I think their other businesses are still doing good. So Meta, and they got a good cash available. So I'm okay with Meta.
I see. Okay, we will discuss next Friday. Next Sunday we will have all the news before that.
Yeah, we'll see what happens. We'll see. All righty, guys. Okay, thank you everyone for attending today. And hopefully you gain something. I learn every week when I come in and talk to you guys. I learn a lot. And hopefully you also get to learn something. And I'll see you next week. Bye-bye.
Bye-bye.
Thanks, Vivek.
Thank
you.
Yep.